Hey everyone, welcome back to the channel. I'm your host, and today we're diving into a hot topic, real estate investment. But wait, before you get too excited, we're going to look at it from a very different angle, through the eyes of none other than the Oracle of Omaha, Warren Buffett. You've probably heard people say, real estate is the safest investment. It holds its value and appreciates over time. But interestingly, Buffett often shakes his head at this idea. He believes that real estate investment isn't as great as many people think. Today, we're going to dig into a conversation between Buffett and his sharp-tongued partner, Charlie Munger, to see why they think real estate might not be all it's cracked up to be. Who knows, after today's video, you might just rethink that real estate investment plan you've been considering. All right, no more spoilers. Let's jump right into it and hear what Buffett and Munger have to say.
We don't have any competitive advantage over experienced real estate investors in the field, and we wouldn't have if we were operating with our own money as a partnership. And if you operate as a corporation such as ours, which is taxable under Chapter C of the Internal Revenue Code, you get a whole layer of corporate taxes between the real estate income and the use of the income by the people who own the real estate.
A particular industry. And I wonder if you could use real estate as an example. I know real estate hasn't been a huge part of Berkshire's portfolio over the years, and I wonder if that's because you view real estate as a commodity business, or if maybe the cash flows from real estate tend to be more predictable than perhaps from some other industries, and thus it tends to be less likely to be mispriced and therefore less likely to find terrific bargains in real estate. So,
go ahead.
So just wondering if we could, if we were watching a discussion between you and Charlie hashing out the merits of real estate, how it would go.
Well, it would go like all our other conversations. He would say no for about 15 minutes, and I would gauge by the degree to which the motion he put into his nose whether he really liked the deal or not. But we both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, you know, they're very similar, but it's a competitive world, and you know, they all know about what a Class A office building in Chicago or wherever it may be is going to produce. So at least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably, to get any big mispricing across the board. Charlie?
Yeah, we don't have any competitive advantage over experienced real estate investors in the field, and we wouldn't have if we were operating with our own money as a partnership. And if you operate as a corporation such as ours, which is taxable under Chapter C of the Internal Revenue Code, you get a whole layer of corporate taxes between the real estate income and the use of the income by the people who own the real estate. So by its nature, real estate tends to be a very lousy investment for people who are taxed under subchapter C of the code relating to corporations. So the combination of having it generally a lousy activity for people with our tax structure and having no special competence in the field means that we spend almost no time thinking about anything in real estate, and then such real estate as we've actually done, like holding surplus real estate and trying to sell it off, I'd say we have a poor record at it.
So how did that sound? Feeling like, wait, this isn't what I thought real estate was about? Well, Buffett and Munger didn't hold back when they pointed out one major drawback for C corporations investing in real estate: taxes. They explained how, before any profits reach a company's owners, they get hit with a big chunk of corporate taxes, which means a lower return on investment. It's like ordering a meal at a restaurant, and before you get a bite, the waiter takes half of it away. Ouch, right? This is one of the key reasons they think real estate isn't exactly friendly to C corporations. And let's not forget, Buffett and Munger run Berkshire Hathaway, a massive company. Compared to those seasoned pros in the real estate game, they admit they don't have any special advantage. So even though they've got deep pockets, it's tough for them to come out on top in this competitive market. Next up, let's listen to Buffett as he talks about some real estate opportunities they missed during the RTC days, and why Berkshire chose to stay on the sidelines back then. Ready? Roll the clip.
Yeah, C Corps really it doesn't make any sense. I mean, I know there are C Corps around that are in real estate, but there are other structures that are more attractive. There really aren't other structures. I mean, Lloyd's is an attempt at it to some degree, but there aren't other structures that work well for big insurance companies. Or, I mean, you can't have a Walmart very well that does not exist in a C Corp. So they are not subject to S Corp or partnership competition that determines the returns on capital in the discount store field. But if you're competing with equivalent of S Corps, REITs, or partnerships or individuals, you've just got an economic disadvantage as a C Corp, which is, for those of you who don't love reading the Internal Revenue Code, it's just a standard vanilla corporation that you think of, all of the Dow Jones companies, all of the S&P companies, and so on. And as Charlie says, it's unlikely that the disadvantage of our structure, combined with the competitive nature of people with better structures buying those kinds of assets, will ever lead to anything really interesting. Although I would say that we missed the boat to some extent during the RTC days. I mean, it was a sufficiently inefficient market at that time, and there was a lack of financing that we could have made a lot of money if we had been geared up for it at that time. We actually had a few transactions that were pretty interesting, but nothing that was significant in relation to our total capital.
We thought significantly about buying the Irvine Corporation when it became available. So, but that's the only big one I can remember that we seriously thought about.
Yeah, that was in 1977 or so.
Way back.
Yeah, Mobil Oil was interested in, Don Brenn ended up putting together a group for it. But
Did it sound like Buffett had a bit of regret there? Don't worry, I'll break it down for you. Back then, the market was full of opportunities, like a big discount sale, but Berkshire Hathaway didn't jump in. Why not? Because at that time, they could only invest through a C corporation structure, which isn't very tax efficient for real estate. In the video, Buffett also mentioned other corporate structures that are better suited for real estate investments, like S corporations and REITs, real estate investment trusts. These structures allow investors to pay less tax and keep more of their earnings. But for Berkshire, it's like those fancy VIP membership cards at upscale restaurants. They just don't have access to them. Still feeling a bit lost with all these terms? Don't worry, let me break it down with a simple example. Imagine two companies, both investing in the same real estate project. Company A is a C corporation and Company B is an S corporation. Let's say they both earn $1 million, but Company A has to pay a big chunk of that in corporate taxes, leaving them with maybe $600,000. Meanwhile, Company B, thanks to its tax structure, can keep more money in its pocket, And that's one of the reasons why Buffett thinks C corporations have a disadvantage when it comes to real estate. It's like running a marathon. If you're wearing boots and everyone else has running shoes, it's pretty clear who's going to win, right? All right, let's wrap this up and go over the key reasons why Buffett isn't so keen on real estate investments. First, there's the tax disadvantage. C corporations end up paying more in taxes, which means lower returns. Then, there's the lack of competitive advantage. Berkshire is like a big fish in a small pond when it comes to real estate, but without any special tricks up its sleeve. And lastly, market pricing efficiency. The real estate market is usually pretty well priced, so it's hard to find those hidden gems that are undervalued. For Buffett, if he can't find a good deal and has to pay more taxes, why bother? And that's a wrap for today's episode. Thanks so much for tuning in. I hope today's discussion gave you a deeper understanding of Buffett's investment philosophy. If you want me to cover more investment topics, let me know in the comments below. Don't forget to like, subscribe, and hit the notification bell. See you next time, and happy investing.